Hello, ladies and gentlemen, and welcome to Not Your Money, an educational platform aimed at demystifying cryptocurrencies and digital assets, making them simple to understand and accessible to everyone. My name is Francesco Mocrismondi, and I'm the founder of Not Your Money. With a 25-year career as a risk management executive serving global banks and crypto startups, I founded this platform to help individuals, corporates, and financial institutions demystify crypto and digital assets and empower them to invest with security and confidence. Just before we start, it's important to emphasize this session and all our materials are produced for general knowledge and information purposes only. Under no circumstances will you find us offering financial advice. Now on to the video. Let's start by unwinding the clock and explore where money started and how it evolved through time. It's quite natural to think about money as pieces of paper and coins. Some of us will even recall using checks. With the arrival of the internet, money became increasingly digital, enabling us to rely on online banking and payment apps of all sorts. But actually, if we take a step back in history, we can witness how money has taken rather incredible forms. So let's explore some of them. In ancient barter economies, trade took form in small villages and communities where individuals traded goods and services against one another, like milk for meat and metals for spices, leather for wheat, and so on. The concept of money was primitive and limited to the value conferred to goods and services by any two parties. As societies evolved, certain commodities were adopted to facilitate trade and make the exchange of goods and services more efficient. Instead of trading individual goods against one another, which was cumbersome and inefficient, specific commodities were adopted instead, working as a medium of exchange. Trade started being conceived in terms of units of any given commodity, be it wheat, stones, cocoa, even seashells, salt, and eventually precious metals. For the most part of human history, trade and economic systems were enabled and supported by commodity money. In comparison, paper money and fiat currency are relatively new monetary inventions, with Bitcoin only joining the mix since 2009. If we look at the money timeline across history, we can see how money forms evolved from one to another, each time improving its characteristics to enable it to be trusted across longer distances, even between unknown counterparties to a trade. As we saw in barter systems, there was no unit of exchange. Goods and services were simply traded against one another. There was no need to use a trusted money form accepted to all trading parties, as trust was simply established through direct proximity and familiarity between trade counterparties. Primitive commodity money, such as wheat, cocoa, stones, and seashells, were adopted as standard mediums of exchange to support trade and commerce. While far from optimal, they provided the best compromise available to make transactions more efficient. Importantly, in relatively close societies, the supply of the chosen commodities, like wheat or seashells, was limited to the immediate territories surrounding small economic areas. This made them reasonably scarce and hard to replicate at scale, and hence an acceptable form of exchange. As societies developed, so did their geographic areas, growing the availability of commodities and making them increasingly more replicable and less valuable. The greater the supply of any given good, the cheaper and less valuable they become. Harder and less replicable forms of money were hence required to be adopted. Precious metals were adopted in different parts of the world as far back as the 7th century before Christ, enduring the test of time all the way to modern times. It's no surprise that precious metals like gold, silver, and copper rose to the top of the commodity chain for their intrinsic properties as medium of exchange, unit of account, but also as a store of value. Their natural scarcity and durability over time made precious metals increasingly desirable items and an ideal asset to accumulate and store for generations. The scarcer the asset, the higher their intrinsic value. It's precisely for these dynamics that gold retains its pristine value over centuries. It is only during the 13th century that paper money came to light as certificates backed by precious metals like gold and silver. Their use dramatically expanded under the Medici family during the Renaissance years in Florence and northern Italy, and in turn were adopted by other private and merchant banks. The Medici family were instrumental not only for bringing paper money and banking at the heart of Europeans' cultural and artistic revolution, alongside advances in accounting techniques known as double-entry bookkeeping. The Medicis were able to spark a huge acceleration in the speed of transactions and bring economic growth to a whole new level. Settling transaction was now possible simply by updating ledgers, which was way more convenient than having to exchange physical metals for each trade. To a large degree, it is to the Medici's innovations that we owe the foundations of how our modern economic system still works today. By keeping their assets with the bank, customers no longer needed to see their holdings settled after each transaction, entrusting the banks themselves to periodically update and reconcile balances for all creditors and debtors to each trade. Moreover, recognizing only a small number of customers actually needed their assets at any given time, banks were encouraged to take risks and increase their money supply by injecting notes and letters of credit well in excess of their customers' deposits. In other words, credit was institutionalized by expanding the monetary base, favoring spending, economic growth, and of course, bank fees. Not long after came central banks, starting with the Bank of Amsterdam in 1609, followed by other central banks like the Bank of England, and only in 1913, with the creation of the Federal Reserve System, otherwise known as the Fed in the United States. Through a practice known as fractional reserve banking, central banks amplify the amount of liquidity in their economies by keeping only a fraction of customer deposits as bank reserves, in case customers require to redeem them at any time. Central banks also became the lenders of last resort, injecting further liquidity in the system during periods of crisis. While the effects of trade and commerce were enormous, there were side effects too, including counterparty risk and bank runs during periods of economic crisis and liquidity shortage. Even then, the base layer of the money, even under central banking, was anchored on gold and silver. Importantly, central banks also attracted another important power, the ability to manipulate their monetary supply as they preferred, in order to improve trade flows and confer economic power to their countries at the expense of others. Currency manipulation turned out to be a double-edged sword, leading to unforeseen outcomes including the hyperinflation and total collapse of nation-states. This happened in Germany under the Weimar Republic, as the country was seeking to pay off the cost of World War I after having decided to suspend the gold standard. Just consider that between 1921 and 1923, the exchange rate between the dollar and the mark reached up to 1 trillion marks per dollar, and a full wheelbarrow of money wouldn't even buy a newspaper. In 1944, towards the end of World War II, delegates from the leading world economies gathered in Bretton Woods in the United States, agreeing to put a stop to currency manipulations and anchor all currencies to the dollar, which in turn was convertible to a fixed price into gold, effectively reigniting the gold standard. The objective of Bretton Woods was to prevent further currency devaluations and promote international economic growth. The objectives were largely achieved in the short run, as we witnessed a post-war economic boom and restored international stability. Bretton Woods also decisively placed the US dollar as the indispensable global reserve currency for all nation-states to hold in their bank reserves around the world. However, in 1971, President Nixon temporarily depegged the US dollar from the gold standard, as the US sought to rebalance its finances due to the growing costs of the Vietnam War, as well as the growing skepticism from European governments, increasingly looking to redeem their US treasuries to recover their gold reserves. This temporary measure was indeed a permanent one, and this is one of the reasons why Bitcoin was brought to the market in 2009. Backed by its underpinning and innovative blockchain technology and distributed network. As we observe the evolution of money over time, it is important to consider that our present monetary and economic system based on fiat currencies are only a very modern development and not at all immune from criticisms and shortfalls. Before we dive into the properties and characteristics of money, it's important to have a good understanding of what fiat money actually is. After all, it's the system underpinning our everyday lives, and yet very few people truly understand how the economic and monetary system functions and affects us all. Fiat money is a type of currency that is not backed by a commodity like gold or silver, and unlike previous forms of money, they have no intrinsic value. Their value relies exclusively on the trust conferred by the public in their issuing government and central bank. In fact, fiat money is considered regulated legal tender and backed by the issuing government. With fiat money, governments and central banks have complete and unconditional power to manipulate the monetary system in ways that were impossible to conceive under commodity money. For instance, by modifying the money supply, printing new currency, or strengthening and weakening currencies by changing their interest rates. While fiat money technically existed in the past, even prior to central banks, it is only since 1971, when the USD pegged from the gold standard, that a new form of money was created altogether. As we know, the temporary measure remained permanent, and unbacked fiat money became adopted as the new monetary standard around the world. This acts as a reminder that the fiat system we inherit today was not intentionally designed to work this way. As a result, fiat currencies are not immune from vulnerabilities and even from total collapse, as we saw happen in Venezuela, Lebanon, Zimbabwe, Argentina, and many other countries around the world. Another way to think about it is by realizing that since ancient barter economies, all money forms were essentially private. The direct value of money was intrinsic to goods and services themselves, be it shells, cocoa, wheat, or even gold, which remained the base monetary layer of our economies for centuries. With the advent of paper money and central banks, we witnessed the first transfer of power from private hands to public ones, at least as far as the control of the monetary base. It is only since 1971, nearly 50 years ago, that our modern monetary form, fiat money, became entirely controlled by the state. As mentioned previously, this is one of the foundational reasons for the launch of Bitcoin at the top of the 2008 global financial crisis. With a growing distrust in the centralized power of governments and the banking system, the core premise of Bitcoin was to create a peer-to-peer form of payment, putting the control back into the hands of privates, with no need for intermediaries whatsoever, be it banks or governments. Put in the words of Karl Menger, the founder of the Austrian School of Economics from the 19th century, money is not an invention of the state. It is not the product of a legislative act. Even the sanction of political authority is not necessary for its existence. Certain commodities came to be quite naturally as a result of economic relationships and independent to the state. I hope you enjoyed our video. If you found the video informative, please don't forget to follow our channel and click the alarm button to be informed of new videos coming through. There is plenty to learn and get your head around on your journey to mastering crypto. Thanks for watching and see you on our next video.